For more on what the downgrade could mean for the markets, let's bring in Ben Emons, the Senior Portfolio Manager, Head of Fixed Income at NewEdge Wealth. Ben, welcome back to the show. As we had been sort of pointing out during our discussion, there are a lot of factors here surrounding this one Fitch downgrade, whether it be what the Bank of Japan is doing, what the Treasury is doing with its issuance. But what's the bottom line impact, do you think?
Yeah, it is on the one hand the Treasury issuance that really played up the Treasury market because that was not priced in. I think when the Treasury made the statement on Monday, traders start to really guess this is not just issuing T-bills just to get that account of the Fed filled up. This is about we're borrowing a lot of money because we have fiscal spending that's expansionary. And we didn't really change it through the debt ceiling. So, you got to borrow to fund it. And that means longer maturity bonds have to be borrowed. And I think that's what got priced in today. On the other hand, the downgrade itself, awkward timing, as I hear the discussion. It's interesting that reference to January 6th, and I think it really is a statement about this is brinkmanship that's going to last. And, that's going to become an issue in the future, right? I think part of the reaction of the stock market is about someone who comes in the White House in the future, and the future administration is going to have to deal with this deficit and rein in spending and maybe go towards austerity at some point, like we experienced in 2011. That's a negative scenario. So that may be somewhat of a reaction in the stock market today on that.
Whether or not you agree with the downgrade or what, the fact of the matter is that, higher yields are really challenging this market, whatever the cause is of the higher 10-year yield. Where do you see yields ultimately going here, at least in the next 6 months or so?
Yeah, you could look at it tactically and strategically. You think tactically, maybe to carry in short, you're going to go towards the upper end of this range, which is around 4.25, 4.3. Because we've got a lot of data come out that's going to likely show surprise strength. And we got the 10-year auction next week that's going to test the market on this supply. But then, if you think longer term, if this is an economy that's really growing but with inflation starting to continue to moderate, then I think you don't really get as high with yields. The deficits are not playing a role there. It's the inflation story.
So, Ben, when we saw today's action, when we saw the large cap tech stocks sell off, in my mind, it would make them more attractive, at least their debt on that side of the equation. So was this a head fake? Where do you think people would rather be, Apple or the U.S. government?
Well, those are focused on ratings, Steve, that you would start to look at Apple, right? That's the AAA rated debt as well as Amazon and others. Obviously, that's not as large of a deep of a market as the Treasury market is. But I think life insurers, pension funds, mutual funds, if they're driven by ratings, they're going to look at that corporate debt that is that high rated. Because the choice for AAA is really small now. You have to look at Sweden or Switzerland or other kind of tiny sovereign markets that that's not as attractive to invest in and not as deep as Treasury. So yeah, Apple debt could be interesting.
Hey, Ben, how about, though, the dynamic with where the Fed is? And the presumption is that the Fed could push things too far or break something. We've used that terminology tonight. And so a Fed hike seemingly should be something that pushes rates lower if the assumption is that the Fed is actually pushing too hard. Can you speak to that? Because that seems to be weighing on the complete other side of this dynamic. And meanwhile, we're in a world where people are now discussing, I've read 3 reports in the last week about how China may be going through decades of a Japanization and the dynamics that we've seen of deflation in these places that had credit bubbles.
Yeah, sure, Tim, because, that is a good point. The Fed hiking further from here would mean that they are winning more and more the credibility of the bond market to bring inflation down. And that should cap yields over time. And that's been the story in the Treasury market over the last sort of 6 months or so. But I think the latest move in Treasury yields is not just hikes, really. Today, if you look at the probabilities for September and October, they didn't really change, even though yields went up. And I think it's more a story about the strength of the economy that came together with this supply story. So, but, if the Fed starts to push further from here, I think the break-evens in the tips market are telling you this. Okay, Fed, you will get this inflation under control if you bring this rate higher. That's a bound positive story.
Do you think that auction will be a really important one, that 10-year one, or not so much?
Well, think of the timing, Karen. So next week, it's the day before the CPI report, that auction. It's a larger size auction now. I believe it's $5 billion more than what it was the last time. We've seen the foreign investors start to move away from treasuries. That's a trend that's developing. So I think that's an interesting moment. Then you get CPI. So we're expecting a bit softer number again. And then on that day, we have the 30-year auction, too, which is going to be larger. So this is a little bit of the test case of what we experienced today. If the market sold off too much because of discounting the supply and it gets actually taken down well in that auction, we'll see. But, this is, I think, a good segue for a good moment to get into that market, perhaps. Good time.